The HELOC to HECM dilemma. Welcome to the Industry Leader Update, brought to you by Reverse Focus. With the recent release of HUD's financial assessment guidelines, our focus was primarily centered on the new requirements future borrowers will have to walk through to qualify for a federally insured reverse mortgage, or HECM, home equity conversion mortgage. Now, the scope of this long-anticipated policy actually overshadowed one key requirement: the seasoning of existing non-HECM liens to be paid off. This pivotal requirement will go into effect with loans with case numbers issued on or after December 15th of this year. What is a typical non-HECM lien? Well, how about the common home equity line of credit, or HELOC? That's correct. If your prospective borrower has recently taken out a HELOC, they may have to wait before they can qualify for a reverse mortgage. Now let's examine this more closely. Mortgagee Letter 2014-21 specifies that mortgagees may permit the payoff of an existing non-HECM lien using HECM proceeds if the liens have been in place for longer than 12 months or resulted in less than $500 cash to the mortgagor, whether at closing or through cumulative draws. Now, to put it simply, a cash-out refinance or the establishment and use of a HELOC taking $500 or more would require a 12-month seasoning period. This new requirement blindsided many, as it was not explicitly mentioned in any previous mortgagee letters, and many feel it would do more harm than protecting the program against occasional abuses, which may stem from such transactions. Now, as the origination community was surprised, our industry was unable to properly prepare potential borrowers with HELOCs to act before the policy goes into effect. Now, while the exact numbers are uncertain, what is known is that some HECM borrowers began taking out a home equity line of credit and then later chose to opt for a reverse mortgage, allowing them to access funds without the required monthly payments. Now, here's a real-life example of the potential impact as illustrated by Beth Patterson, Executive Vice President of Reverse Mortgages, SIDAC. Now, she recently closed a HECM for a client who needed to pay for home care services. The home care agency was pressing for immediate payment at the time of service prior to her ability to secure a reverse mortgage. So she took out a HELOC in the interim to bridge the gap. Now, next month, such transactions will not be possible. Now, here's the upside. FHA's new authority to enact policy outside of the protracted rulemaking process means such requirements could be revisited or modified in the future. Now, it's a possibility, but not a certainty. In the past episodes of this broadcast, we have discussed the pitfalls that HELOCs pose for older homeowners. Now, perhaps this new seasoning requirement will push our industry to increase its efforts to educate prospective borrowers of the key differences and advantages that a HECM line of credit holds over a traditional home equity line of credit. Now, what are your thoughts on this new seasoning requirement for non-HECM liens being paid off? Leave your comments in the comment section below and have a great week.